Right now, you are being manipulated. You turn on the television, and every major network is broadcasting images of burning oil tankers in the Middle East, soaring gas prices, and political debates about border security. They are keeping your eyes glued to the horizon so you do not look at what is happening inside the vault. On April 7th, 2026, while the public was consumed by the geopolitical theater, a federal judge quietly blocked an unprecedented attempt by the Department of Justice to subpoena the chairman of the Federal Reserve, Jerome Powell. Let that sink in. According to a bombshell report from Axios, the executive branch of the United States government attempted to legally strong-arm the head of the independent central bank. This is not just a courtroom drama. This is a terrifying stress test of the global financial architecture. For a century, the power of the United States dollar has rested on one singular pillar: the absolute independence of the Federal Reserve. The central bank must be able to set interest rates based on mathematical reality, not on the political survival of whoever is sitting in the Oval Office. But right now, we are witnessing a systemic institutional civil war. The government is running a massive deficit, printing money to fund global conflicts and domestic subsidies. This reckless spending has cornered the Federal Reserve into a nightmare scenario. If the Fed cuts interest rates to please politicians, they unleash hyperinflation that will destroy your grocery budget. If they keep rates high, they crush the government's ability to service its own debt. The subpoena attempt by the Department of Justice was a raw display of power, a warning shot across the bow of monetary independence. When the authorities try to use the legal system to force the hand of the money printers, you know the system is nearing a breaking point. The federal judge stopped it this time, but the very fact that the executive branch tried to pierce that firewall tells you everything you need to know about the desperation in Washington. They are running out of other people's money, and they are looking for the override switch. Are you starting to see how the headline news is just a distraction from the structural tectonic plates shifting beneath your feet? Drop a comment below and tell me if you trust the central bank to withstand this political pressure, because what happens next directly impacts the purchasing power of every dollar in your bank account. If you think your retirement savings are safe just because they are sitting in a diversified index fund, you need to wake up immediately. The Washington Post just broke a story that should send chills down the spine of every working American. The Department of Labor has proposed a radical new regulation that would crack open the doors of 401k retirement accounts to alternative assets. Specifically, they want to allow your pension funds to be heavily invested in cryptocurrency and private equity. On the surface, Wall Street is selling this to the public as quote-unquote portfolio diversification. But here at PrismNews, we read the fine print. Let us look at the macroeconomic reality. Because the Federal Reserve has been forced to keep interest rates in restrictive territory to fight sticky inflation, the initial public offering market, the IPO market, is essentially frozen. Private equity firms are currently sitting on mountains of illiquid assets. They bought up companies during the era of 0% interest rates, and now they cannot sell them. They are facing a severe liquidity crisis. They cannot cash out to return profits to their limited partners. So, what is the smartest, most ruthless move they can make? They lobby the government to change the rules so they can dump these illiquid, hard-to-price assets into the retirement accounts of the American middle class. They are turning your life savings into their exit liquidity. By granting private equity access to the trillions of dollars locked inside 401k accounts, the financial elites are executing a massive transfer of systemic risk. You, the everyday worker, will now bear the burden of illiquidity risk and the opaque valuation models of private assets. And it does not stop there. Private equity is not just playing with high-tech startups anymore. They have aggressively expanded into core social infrastructure. Recent investigations reveal that the massive influx of private equity capital is the primary driving force behind the skyrocketing cost of childcare in America. They have taken an essential social service and transformed it into a financialized profit maximization engine, directly eroding the disposable income of young families. Your retirement money is being used to buy up the very services that are bankrupting you today. It is a brilliant, vicious cycle of extraction. While the government rolls out the red carpet for institutional capital in the virtual asset space, they are simultaneously executing a highly publicized crackdown on physical assets. Axios reports that the administration is proposing a comprehensive, nationwide ban on large institutional investors purchasing single-family homes. The political narrative here is highly digestible. Stop the greedy Wall Street hedge funds from buying up the neighborhoods so that ordinary families can afford the American dream again. It sounds like a victory for the middle class, right? Wrong. In economics, every intervention creates a ripple effect, and this one is a tsunami. By banning institutional buyers, the government is deliberately destroying the liquidity of the build-to-rent market. Real estate investment trusts, or REITs, provide the massive capital required to develop large-scale housing projects. Without them, developers lose their biggest guaranteed buyers. But you have to combine this data point with another critical report from the Washington Post. The Department of Housing and Urban Development, known as HUD, has joined a hardline campaign to evict undocumented immigrants from subsidized housing. When you launch a sweeping crackdown on the undocumented population, you instantly vaporize the cheap labor pool that the construction industry relies on to build new homes. So, let us do the math. The government has simultaneously driven away the institutional capital needed to fund new housing projects and eliminated the affordable labor needed to build them. The result is a catastrophic double barrier. The cost of developing new real estate is going to skyrocket, which means new housing starts will plummet. The supply of affordable homes is not going to recover. It is going to freeze entirely. They are sacrificing long-term housing supply for a short-term political talking point. This is how the system forces you into a permanent renter class, subject to the whims of inflation. The media wants you to cheer for the ban on institutional buyers, but they hide the mathematical certainty that this policy will make rent and home ownership even more expensive for the next decade. The classical models of economics that they teach in universities are completely failing to explain the reality of April 2026. The latest jobs report, verified by both Axios and the Washington Post, shattered all conventional expectations, but not in the way you might think. We have officially hit what analysts are calling the new speed limit of the American labor market. Historically, the United States economy needed to create well over 100,000 new jobs every single month just to absorb population growth and keep the unemployment rate stable. That baseline has now collapsed to near zero. The terrifying truth is that even if job growth drops to a flat zero, the economy is still operating at full employment. How is this mathematically possible? Because we have hit a structural demographic wall. The workforce is aging out rapidly, and there are not enough skilled younger workers replacing them. A report from the Associated Press highlights how this severe scarcity is spreading to highly specialized trades. The rapid aging of skilled garment workers and tailors is driving the cost of apparel, maintenance, and production to alarming levels. This core labor scarcity is forcing corporations into a state of panic known as labor hoarding. Companies are terrified of letting workers go, even when consumer demand softens, because they know how impossible it will be to rehire them later. This breaks the traditional boom and bust cycle of the economy. The labor market is acting like a yo-yo, experiencing violent swings between mass creation and sudden losses. But the underlying trend is undeniable. Human labor, specifically skilled physical labor, is becoming a rapidly depleting resource. This demographic crisis guarantees that wage inflation will remain sticky. Businesses have to pay a premium just to keep their doors open, and they will absolutely pass that cost on to you at the cash register. We are not experiencing a temporary economic cycle. We are living through the permanent restructuring of human capital. When macroeconomic shocks hit the system, the economy does not suffer equally. The first quarter earnings reports of 2026 have drawn a brutal, unforgiving line in the sand between corporations that possess absolute pricing power and those trapped at the bottom of the physical supply chain. The Wall Street Journal just published a piece exposing a brilliant investment paradox. Traditional value stocks have completely lost their appeal, suffering massive capital outflows. Yet, simultaneously, domestic chemical manufacturers in the United States are seeing a historic explosion in profits. Why? Because the global scarcity of raw materials, exacerbated by the ongoing geopolitical conflicts and the closure of critical logistical choke points like the King Fahd Causeway in the Middle East, has handed American industrial plants total pricing power. They control the upstream supply of essential chemicals, and they can charge whatever they want. They are forcefully reallocating profit margins away from consumer-facing sectors back to the core production layer. Contrast this with companies trapped in the physical world. Reuters reports that Phillips 66 just posted a staggering $900 million loss. How does an oil refining giant lose nearly $1 billion during an energy crisis? Because the cost of raw crude oil skyrocketed faster than they could raise prices at the pump. When input costs destroy your profit margin limits, you bleed cash. Air New Zealand is facing the same grim reality. Forced to slash flight frequencies and hike ticket prices because their fuel costs doubled overnight, they are actively destroying their own international competitiveness just to survive. But the evaporation of profits in the physical economy is acting as rocket fuel for the digital economy. Reuters confirmed that Samsung is forecasting a mind-bending 800% surge in quarterly profits, driven entirely by the global frenzy for artificial intelligence chips. Broadcom just locked in a massive, long-term strategic agreement to develop custom AI silicon for the Google ecosystem. Controlling the supply of advanced semiconductors in 2026 gives these tech giants the exact same monopolistic power that oil barons held a century ago. The reallocation of economic power is most visible when you look at how massive retail conglomerates are shifting their risk onto the public. The logistics crisis is tearing through supply chains globally. The Red Sea is a danger zone, insurance premiums for shipping are astronomical, and domestic trucking is bleeding from fuel costs. So, what does a trillion-dollar empire do? Reuters reports that Amazon has secured an unprecedented exclusive agreement with the United States Postal Service to guarantee 80% of its delivery volume. This is a masterclass in corporate survival. By leveraging its supreme negotiating position, Amazon has effectively locked in its logistics costs. They have taken the massive inflationary risks associated with transportation, fuel spikes, and driver shortages, and they have transferred all of that risk onto the balance sheet of the state-run postal agency. Amazon preserves its retail profit margins right in the eye of the inflation hurricane, while the American taxpayer ultimately underwrites the losses of the USPS. This is why smart money is running away from traditional physical logistics companies. They are seeking shelter in business models that control the digital platform layer and possess the political leverage to socialize their losses. While small retail chains are being crushed by freight costs, the monopolies are using the government as their personal shock absorber. Furthermore, the persistent nature of consumer inflation reveals a deeply asymmetrical power structure in retail. Axios highlighted a fascinating data point during the Easter shopping season. Even though the price of raw cocoa plummeted on the commodities exchange, the end consumer still paid record-high prices for chocolate products. Retailers refuse to lower prices when input costs drop, but they instantly raise them when costs go up. This one-way price inelasticity proves that current inflation is not just a simple supply and demand imbalance. It is being artificially sustained by the price-setting power of retail oligopolies. They are extracting every last drop of consumer surplus from a population that is addicted to trends, like the viral squishy toys phenomenon that drove localized sellouts. While the physical markets burn, the American judicial system is quietly paving the way for the financial models of the future. The architecture of risk assessment just experienced a systemic paradigm shift. Reuters reports that a United States appeals court has officially ruled to strip the state of New Jersey of its authority to regulate and restrict Kalshi, the leading prediction market platform. The macroeconomic implications of this ruling are staggering. It officially legalizes and protects the freedom of contracts that predict real-world events. For decades, we have relied on biased media polls and flawed punditry to gauge the probability of political outcomes, economic shifts, and geopolitical conflicts. Now, institutional capital is legally allowed to participate in pricing the probability of reality. Prediction markets provide a vastly superior stream of alternative data. When millions of dollars are on the line, the algorithms and the participants strip away emotional bias. They react faster and with more accuracy than any traditional polling mechanism. This court ruling transfers the power of narrative prediction away from the media and hands it directly to the financial markets. Parallel to this, the legal system is also being dragged into a brutal war to define the future of artificial intelligence. OpenAI has officially requested regulators in California and Delaware to investigate Elon Musk for anti-competitive behavior. This is not a petty billionaire feud. This is a cutthroat battle to establish an ideological and technological monopoly. The legal precedents set by these investigations will determine the cost structure, the limits of data sharing, and the profit distribution models of the entire AI industry for the next decade. The elites are fighting in the courtrooms to see who gets to control the cognitive infrastructure of humanity. We have anatomized the forces ripping apart the month of April 2026. The macroeconomic environment is not merely experiencing cyclical inflation. We are suffering from the structural fracturing of globalization itself. Pursuing fiscal stimulus policies in an environment of absolute physical scarcity is mathematically futile. As the AP reported, rising gas prices instantly devoured all the benefits of the spring tax refunds, leaving household budgets in a deeper deficit. The era of blindly throwing money at index funds and hoping for steady returns is dead. So, what is the solution? Where is the smart money actually going? Bloomberg recently published a piece that provides the strategic escape hatch. While the physical world is being carved up by tariffs, closed bridges, and geopolitical blockades, the value of global digital services trade has quadrupled, reaching a staggering $3.8 trillion. Transferring value through the digital network has become the ultimate safe haven. It allows capital and intellectual property to bypass physical borders entirely. For institutional capital and retail investors alike, strategic wealth must be redirected away from business models that are highly sensitive to physical transportation costs and lack defensive moats. You must increase your exposure to the monopolistic choke points of the digital economy. The entities that control the infrastructure for AI development and the platforms for digital services trade will provide the most impenetrable shield against the corrosive pressure of structural inflation. Do not let the cortisol tax of the mainstream media cloud your judgment. Recognize the wealth transfers happening in plain sight, like the opening of your 401k to private equity. Protect your purchasing power, pivot your mindset to digital scarcity, and survive the restructuring. If this analysis opened your eyes to how the machine truly operates, subscribe to PrismNews and hit the notification bell. Leave a comment below on how you are shifting your own portfolio to survive this decade of brutal transition. Stay vigilant.